So what they want us to do for them is to prepare a group statement of cash flows for the year ended 30th September 2013 in conformity with International Accounting Standards IS7 statement of cash flows. So I'm going to use the indirect method there. I'm going to use the indirect method. And when we're using the indirect method, can somebody in this case here tell me under operating activities, where are we supposed to begin from? What is supposed to be the first item under operating activities? Operating activities, of course, I know the name of the group. You guys will be able to write very well, right? So the operating activities, what should be the first thing? My mom tells me it should be the profit before tax, not cash received. It should be the profit under indirect method. Under indirect method, I'm using indirect method, so it should be profit before tax. It should be profit before tax. So the profit before tax, is there somebody who is able to see the profit before tax in this question? The profit before tax in this question, is there anybody who is able to see? Go to the income statement. So profit before taxes, and gentlemen, what do we have here? I can see it here. It's a profit before tax. 17 what? 1740. So profit before tax is 1740 here. So profit before tax is 1740. So this 1740, we have to adjust this 1740 for some non-cash operating expenses, because at the end of the day, what we want is the cash flow. Is the cash flow. What we want is the cash flow. So to come and mention here, adjusted for. So you mention here adjusted for. Adjusted for. So remember, ladies and gentlemen, in this case here, the non-adjusting expenses, if you remember, simply come and remind us here the concept of dial God's number. There are only 5. Dial God's number, right? Dial God's number. They adjusted for. So the first one should be depreciation. Depreciation. We have impairment of goodwill. We have amortization. Amortization of other intangible assets. Amortization of other intangible assets. We have loss on disposal. Loss on disposal of assets. Loss on disposal of assets. Then we have the gain on disposal of assets. On disposal of assets, like that. So most important, you can remember this very fast. Dial God's number, that's what they tell us. So ladies and gentlemen, we have the question here. Are you able to see in this case here any depreciation? Yes. If you look at note number 1, the cost of sales includes depreciation of PPE amounting to 640 and a loss on sale of plant over 100 million. So we have 640 is the depreciation. So depreciation is 640 here, 640. And then I can see there is loss on disposal of 100. Loss on disposal of 100. So are we together there for note number 1? Are we together there? Are we together there? Yes. Are we together? So note number 1. From there, ladies and gentlemen, let's look for what here? Any impairment. Remember, impairment is for goodwill. Impairment is for goodwill. So you can see goodwill, 2012 was 400. And then we have 2013 is 360. Remember, ladies and gentlemen, for these assets and liabilities and even equity, these guys must give us 2 years to compare, isn't it? 2 years for comparison. So when they talk of, for example, we have 2013. So 2013, we have 31st of December, 2013. And then, of course, we have, ladies and gentlemen, here, 1st of January, 2013. So they'll always give us figures for the previous year. Why are they giving us figures for the previous year? It's because of this. You see, this start of this year is automatically the end of last year. So 31/12/2012, like that. So when you see, for example, them giving us 2012 figures and 2013 figures, the 2012 figures are opening balances. Their balances brought down. Their balances brought down. So if I'm to do this goodwill statement, ladies and gentlemen, this goodwill statement, if I'm to do it as an account, goodwill, so I'll have here balance brought down and the balance carried down. So brought down, of course, is the 2012 one. Carried down is the 2013 one. So in this case here, goodwill What do we have for goodwill? So goodwill, we can see 2012 brought down is 400. And then 2013 is 360. So 400 and 360. So we have here 400 and 360. So this was quite a simple question that I chose because I never wanted you guys, the time now here is not the proper time to teach you tough things. So here there was no any subsidiary that was acquired in the year, and there was no any disposals in the year. So this account should be a self-balancing account. So come here, ladies and gentlemen, and do the balancing. So the balancing here, we have 400, 400. So it means that this reduction is what here, somebody, is our impairment. The reduction is our impairment. So in this case here, what is the impairment loss? So the impairment loss here will be what here, somebody, will be 40. Will be 40. So the impairment loss is 40 here. The impairment loss is 40 there, right? Remember, amortization is also loss in value of intangible assets. These two is loss in value of intangible assets. But specifically, impairment is for goodwill and the amortization is for other intangible assets, like the patents, etc. So do we have these other intangible assets? Oh, yes, we have them. So other intangible assets, you can see intangible assets are set at book values and comprise, we have other intangible assets. So at the beginning, we had 200, at the end, we had 940. So come and give us a T account if you wish for other intangible assets. Other intangible assets. So the other intangible assets is an asset brought down. I can see 2012, 200 versus 940. So brought down 200 versus 940, 200 versus a carried down of 940. Of course, when I see this thing increasing like this, somebody who understands FR very well will tell you that there must be an acquisition in between. So please try to look for a note talking about other intangible assets that were acquired. They've told us here other intangible assets acquired during the year amounted to $1 billion or 1,000 million. So when we acquire, what do? We credit if we paid for them. Credit bank. Debit this asset here. So we have other intangible assets acquired. So acquisition new, it will be a debit like that. So come, ladies and gentlemen, and give us the total. Give us the total here. So this gives us 1,200. This is 1,200. Is there somebody who is able to give me the balancing figure here? Is there somebody who is able to give me the balancing figure? Balancing figure. So balancing figure, what are you able to see? Balancing figure. Balancing figure, what are you able to see? 200 and what here? 60. 260. So the balancing figure is 260. So of course, this automatically, given that it is on the credit side, that is lost in value. Lost in value, but now we are calling what here? Amortization. So this is the amortization like that. So the amortization here is 260. Is 260. Is 260. Is 260. Is 260. Now, of course, in most cases, when you have loss on disposal, gain on disposal may not be there, right? So this gain on disposal, if it's there, of course, I'll put it here. And it's the only thing, when it is there, it is the only thing that you do what you subtract. It is the only thing that you subtract. It is the only thing that you subtract, right? Now, from there, ladies and gentlemen, what I'll do, I'll come very fast here. I would come very fast here. And then remember, after I've been able, ladies and gentlemen, to tackle this concept of dial God's number, very important. I'll have to come and look at what here, this profit before tax. So the profit before tax, I'll go back to my income statement. So back to my income statement, what do I have? Back to my income statement. If you remember, the income statement is here. We have profit before tax. So this profit before tax, ladies and gentlemen, I can see a figure of 1740. And then now you are being told here to look northwards. Okay, so in this case here, this profit before tax now look upwards like that. So identify the non-operating activities which fall upwards there. Non-operating, remember, we have got 3 or rather 4 operating activities here. Which ones are these? The first operating activity is revenue. We have cost of sales. Cost of sales. We have cost of sales. We have in this case here any administration expense. Any administration expense. And then we have, of course, any distribution expense. These are called what here? Operating items. Operating items, operating items, operating items. At times, this administration and distribution, they are called what here? Operating costs. Operating costs like that. Operating costs. So when I'm looking here upwards, I'm identifying, I know that this is operational, this is operational, the 2 here are operational. Any other item that is here, which is not coming from the 4, is non-operational, is non-operational, is non-operational. So ladies and gentlemen, what are we able to see here? What are we able to see here really? If you look at this profit before tax, when you go up, sales is operational, cost of sales is operational, gross profit, they got gross profit by subtracting, operating expenses are operational. I can see finance cost here is non-operational. Over how much? 60 of 60. So this finance cost is the only one which is non-operational, which I should be able to go and cancel. So I need to come here very fast. I've been able to identify a non-operational expenditure. So I'll be able to say here, finance cost. So finance cost over how much? Finance cost of 60, Bob. Finance cost of 60. Finance cost of 60. Finance cost of 60. Adjust the board. Okay, just a minute, just a minute, just a minute. Called Odinga told us for working capital changes, we should always remember the rest in peace. For working capital changes, always remember rest in peace. Rest in peace. Where this R stands for receivables. This R stands for receivables. This stands for inventory. This stands for inventory. This stands for payables like that. Payables. So working capital changes. So ladies and gentlemen. Okay, so ladies and gentlemen, in this case here, are you able to remember what we discussed about these things? Are you able to remember what we discussed about these things? Yeah. So in this case here, we start with OC. Thank you very much. For receivables, it's OC, OC. This one here is CO. Payables is CO. Yes. So OC means what? You are taking opening minus closing. So you are taking opening, which is the 2012, minus the closing. This is very easy. Change means you're subtracting change, right? So for receivables, I should take what minus what? Opening minus closing. Opening minus closing. So for receivables, I should take here opening for receivables. So go for your current assets, accounts receivable, you can see them here. So we have the opening one is 1360 minus 1980. So for receivables, we are taking 1360 minus 1980. 1360 minus 1980. 1360 minus 1980. 1360 minus 1980, which will end up giving us how much here for receivables. So you take the 2012 figure minus the 2013 figure. David tells me it is minus 620. So we'll come and put this minus 620 there, like that. Minus 620 like that. So you don't have to keep on reasoning like this one is an increase. It'll do, no. That's none of your business. If it's negative, you write there negative. So please go and do the same for inventory. Go and do the same for inventory. Go and do the same for inventory. So for inventory, what do we have? Remember again, it's OC. It's OC. Opening 1880 minus closing of 2840. Opening is 2012. 1880 minus 2840. Is there somebody who is able to see that negative? Is there somebody who is able to see that negative for inventory? What do we have there, somebody? For inventory, somebody is giving me a figure of 960 negative. So minus 960. And then we have payables. Lastly, we reverse. It's closing minus opening. It's closing minus opening. It's closing minus opening. It's closing minus opening. So for payables, accounts payable, remember here it's closing 2013 minus opening of 1460. 1750 minus 1460, which ends up giving me how much? Remember, for payables, that's how you cram it. It's closing minus opening. Otherwise, you'll start doing that language of reasoning is an increase or be a negative. No, we don't want to go that direction. So they're telling me that this one here should be 200 what here? Should be 290 like that. Should be 290 like that. So what do we have here? What do we have here? So if you look at these, add all of them, give us a figure. Give us a figure. Of course, I had to put this excess there just for you to know that gains are always subtracted. Gains are always subtracted. So could you kindly take all this and then give me the total figure here? 1740, you're adding this, add. If there was anything there, you subtract. Plus 60, this minus 290. And then we'll be able to give us, ladies and gentlemen, operating activities, net cash flow from operating activities. I'm being given a figure of 1550. I'm being given a figure of 1550. So this 1550 is what I'll bring here as the net cash flow. The net cash flow from operating activities. So don't forget that we've got how many sections? We've got how many sections? 3 sections. Cash flow from operating activities, cash flow from where? Investing activities, and the cash flow from financing activities. Financing activities. Remember, the idea here was to do the first part alone. Now, as we come to our exams, close to our exams, those things I'll be doing here for 10 minutes, and then we call it a day. So please go ahead and for those of you whom I've invited today, right, who are guests here, go ahead and pay us and join our classes. Join our classes. Should you, in this case here, want our classes, of course, you know our number, 0719 525,000. So I'll be able to upload the whole solution. I'll be able to upload the whole solution of this question on YouTube. And then I would expect you guys to do what here to watch on YouTube. And when you come across my YouTube, and ensure that you do what here you like those things, make comments there, and ensure that you subscribe. Very important, very important, very important. Otherwise, good night. Bye-bye. Bye. Bye.